Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with the Tom Wheelwright, accountant extraordinaire, and very interesting topic, Anthony. We talked to him about oil and gas, and man, we are almost 300 episodes in, and this is the first time we're talking about oil and gas, and there's a reason for it.
Why is that, Cameron?
Several reasons. One, our comfort level with oil and gas is pretty low. My personal experience from what I've heard in the industry is that there's a lot of fraud. I've seen it maybe second or third hand. And so for those reasons, I haven't felt very comfortable kind of exploring that area, to be honest. We've looked for a guest previously and haven't found someone that we believe was creditworthy. So we've talked to Tom previously. He's an expert in this area, so it's great to have him on.
Yeah, I've always had some great questions. We've inquired about this, but so we decided to go to the source. Last time we had Tom on, he said he'd love to come back to talk about oil and gas. So we wanted to take that opportunity to have somebody independent, right? He has no skin in the game. He's not trying to sell any sort of oil and gas investments. However, there were some good takeaways.
There was.
And a quote, I don't think I'm going to do a good job quoting it because I just messed it up before. But one thing Tom said is don't let the tax tail wag the investment dog or something like that. But
it was close enough.
What he's saying is don't do an investment solely because of the tax consequences on it, because the tax benefits on this are pretty cool. You could put in, say, $100,000, deduct $80,000 that year, and you can deduct that $80,000 against other income. So this, I think, is something a W-2 employee looking for some tax benefits has some tax benefits. But again, just like Tom said, we got to be careful about the investment, not just do it solely because of the tax benefits. And also one thing, and this probably was really different than what the podcast topic is, but Tom had mentioned that they do a Wealthability Live. Or I'm not sure what they're branding it, but
that's what he said. He said Wealthability Live.
Twice a month, they're having a live webinar where you can ask the expert, and sometimes that expert's Tom, where you can ask them tax questions. And another benefit, I think, is hearing questions from other people.
Yeah.
Because a lot of times you might not have a question, but somebody else may have a great one. And this is $97 a month for 24 sessions.
That's a deal.
I tell you, I'm going to go sign up right after this. This is a great way because taxes are a big expense that we have, and we need to learn to manage it. Cameron, any takeaways that you had?
I would echo that one for sure. I have it circled on my note sheet here. Great value that can be found there. Also, what I had circled on my sheet was these three words: was proceed with caution. Right? Again, we've been around this industry. I've heard about a lot of scenarios in which investments have not worked out. And even Tom said we asked for a range of outcomes for investments, and he said, first is going to expect to lose all your money, right? And anything up and above beyond that is going to be great. So again, very cautious I would say proceed with caution with this investment in this niche. So that was my takeaway. The other thing that he said was, if you do go down this road, is make sure you're putting in the time and energy to perform the due diligence on the team that is going to be managing that investment for you. So some great info, great insight. Again, we just wrapped up our interview. Tom Wheelwright, he's entrepreneur, best-selling author, Rich Dad advisor, and international authority on taxation, who specializes in teaching how the government can actually become your biggest ally in achieving financial independence. And he was here today to help you make more money and pay less in taxes.
Enjoy the episode.
Take care. If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad, Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Oil Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we've got a guest that really doesn't need an introduction. Mr. Tom Wheelwright, welcome back.
Thanks so much. Always good to be with you guys. I love talking about this stuff.
Absolutely, Tom. And I was sincere as far as no introduction, but I will ask, today we're talking specifically about oil and gas, and we haven't touched on this topic intentionally in our 250 plus episodes, right? And so we're excited to have you on today. I think most of our listeners are going to know who you are, but maybe share a little bit about your background and how it relates to oil and gas.
Yeah, so I actually, so I went to school at the University of Texas during the boom days of the mid 80s, the early 80s actually. And when nobody had heard of Midland, Texas, unless you lived in Texas. And so I actually took an oil and gas law class, oil and gas law. And then I started my career at Ernst, back when it was Ernst & Winnie, in Salt Lake City. And that was the big natural gas boom, where all the farmers, had all these wells. They found all this gas, and gas prices, natural gas prices were high. And of course, wasn't long after that, they capped all those wells. A lot of those wells are still capped because gas prices have come down so far. I think that they've started to go back up. So I did that. I actually, one of the first clients I worked on with Ernst & Winnie, they had this guy had an interest in over 300 oil and gas wells. We did it on a 14-column spreadsheet by hand.
Was that like the green journal?
The green spreadsheets. And we actually had to tape them together. And we had, in the tax department, we had one Apple II computer. So this is, I know dating me, but this is back in the early 80s, right? We had one Apple II computer for the tax department, one for the audit department. I actually took, this is back when we had VisiCalc. This was before SuperCalc and before Excel and Lotus and all that stuff. And I actually took that spreadsheet and created the first spreadsheet, oil and gas spreadsheet, that the firm had seen. And learned, I learned oil and gas at, early in my career. And then when I was in the national tax office in DC, one of the partners I worked with, I was the only one in national tax besides this partner who was interested in oil and gas. And he actually wrote a lot of the work for B&A Portfolios, the big research company, and Bloomberg. And so I actually got to help him write those portfolios. So I've just got a long history of oil and gas, and I've been an investor in oil and gas. I've invested in those that are good and those that are bad. And to me, it's just, energy is what makes the world run. So it's a very interesting topic. And of course, the tax benefits are so good that it's very tempting for people to invest in oil and gas because of the tax benefits. But as I'm sure we'll talk about, that's not really the best reason to invest in oil and gas.
Interesting. Can't wait to get to that. Tom, I will kind of tee up there. You teed us up. Is on page 228 in your book, Tax-Free Wealth. One of the comments you make is in the U.S., oil and gas is one of the truly great tax shelters. Give us some details on that. What are you referring to there?
Yeah. So in any other investment since 1986, if you are a passive investor, then you can only offset your losses from that investment against passive income. That is not true in oil and gas. There is a carve out in the passive loss rules for oil and gas, so that if you invest in an oil and gas drilling program, you are a general partner, so you have unlimited liability except for insurance. So they always provide the insurance coverage if it's a good driller. But you have to be a general partner. So you can't invest through a limited liability company, a limited partnership. You've got to be a general partner. You're on the hook. If you do that, then you're not, then the passive rules don't apply. So here's why that's important, because the first year of drilling is where all the money's spent, right? And you put $100,000 to oil and gas, $80,000 of it is going to be used in the first 3 to 6 months to drill the well. And most of that is going to be intangible drilling costs. And intangible drilling costs are all the labor, everything they do other than the actual equipment and the lease itself, right? But the lease is typically paid in a royalty. You don't actually have a lot of hard costs for the lease. It's typically a royalty interest, and you're just required to drill. And what you're getting is, you put in 100,000, you could get an $80,000 deduction in year one. It actually gets even better than that, because you actually have until March to start drilling. So you can get the deduction in December and not start drilling until, you don't have to spud the well, is what they call it. You don't have to spud the well until March. So they can raise the money at the end of the year for projects that they're going to, they're going to do in January, February, March, and the investor still got the deduction in the previous year. So that's what makes oil and gas. You don't have to be placed in service like you do in real estate. You don't have to have tenants. You don't have to be marketing or anything. You have to have the well, because you want to make sure that you invest in something real. But you don't actually have to start drilling until March.
Now, Tom, most of the time what I found in the tax code, it's kind of like, it's like a give and take. Like let's take, for example, IRAs. You can either have a traditional where the tax deduction going in, tax going out, or a Roth, you pay tax going in, tax-free going out. Like, it's kind of like a balancing act. But I'm waiting for the catch. Like, you get a big deduction in year one. What happens in year two, Tom?
Not a big catch, because what happens in year two, first of all, you're going to start getting depreciation. So if you had bonus depreciation, when we had bonus depreciation back in 2022, right? 100% bonus. Then what we got was, we got 100% of the intangible drilling costs, but we also got 100% of the equipment costs. So people were getting on a $100,000 investment, right? And so, but that's over 2 years, because you don't get the bonus depreciation until you actually put it in service, right? Mm-hmm. So you get the 80%, say in December, and then you get the next 15 to 20% the next year. But what makes oil and gas unique, other than tangible drilling costs and the passive loss rules, is that you also are only taxed on 85% of the income. So you get what's called percentage depletion, which means that it's like depreciation, only you don't actually have to have any tax basis to get it. It's like a pretend, it's like a phantom deduction is what it is. But you get the deduction. So you get a deduction of everything you put in, and you only pay tax on 85% of what you get out. So it's really it's a really significant tax benefit in the tax law.
So you pay tax on the 85%. What tax rate is that?
That's going to be ordinary income rates. Now, what a good developer is going to do is, in year two, when you start to make money, they're going to actually convert you to a limited partner. And at that point, you won't have any self-employment tax. So you'll still have ordinary income tax, but you won't have self-employment tax. You can get away, you can get around the self-employment tax just by being a limited partner. Now, you could probably do it by putting it in your own limited partnership, but a good driller, they'll do it automatically. They'll convert your general partnership interest to a limited partnership interest as soon as the well starts producing income.
Now, I could also see that you get this big deduction year one, and then you start. What are some, I know you're not a financial advisor, Tom, but what's like a range of expectations of a return?
So, unfortunately, the range of expectations should go from losing all your money and never getting anything back to making, I've got clients that have had 4 to 5 times return on their investment. So it's a very broad range. And, we kind of mentioned it before we started recording. The biggest issue is that there is a lot of fraud in the industry. Yeah. And it's easy to be fraudulent because you can't see it in the first place, right? It's not like real estate where you can actually go see the building, right? They can't hide the building from you. They can't say, well, it's this property in Dallas, Texas, or Grapevine, Texas, and here's the address. But sorry, but you can't see it, right? That's kind of what oil and gas is like. So here's the well. It's in Midland, Texas, or it's in the Balkans in North Dakota, or it's in Oklahoma somewhere. Okay, but by the way, here's all the drilling. Here's all the reports. Right, the engineering reports, which nobody can understand. I think half the engineers don't understand them. But trust us, the oil's there. And on top of that, it gets even more challenging because just because the oil's there doesn't mean you can get it. Because remember, you have to actually figure out how that whoever's drilling it has to figure out how to extract that oil. And if they run into bedrock or they run into some sands that clog things up and they can't get through the sands, then they've got an issue. So it's a lot more complicated than real estate. Real estate's, really pretty simple. I mean, people own houses, so they get real estate, but you don't typically have an oil well in your backyard. So unless you live in Midland. So what happens is that people get swindled by the lure of the tax benefit. And so I always tell people, don't let the tax tail wag the investment dog on this one.
What are some things an investor can do to help protect themselves?
First of all, absolutely do your Google search, do your research into the team that's investing. So most oil and gas deals, there's, a lot of fracking going on, and those can be anywhere from a mile to 2 to 3 miles horizontal. So you're drilling down and then you're drilling outward, and you break up all the shale and all the oil flows back into the pipe basically, and you pump it out. That's basically how fracking works. There are some that they actually go in and do what we call secondary and tertiary recovery, where they go in and they actually take wells that have already been drilled and they're just they're using chemicals and other ways to extract more of the oil out. Those tend to be a lot less risky, but produce low returns. Okay, but they're not very risky because we know the oil's there. We know we can get to it. So that's a little less risky. And there's some companies that's all they do. Okay, and then there are other companies that they're doing exploration. So they don't even know the oil's there in the first place. They certainly don't know if they can get it. Those are the riskiest. That's called exploration. Whereas the development, most of what's happening is that the driller, there are wells around the drill site that you have an interest in, and they've been successful. So they know there's a pool of oil down there. You just have to drill. Typically what's happening is the bigger developers like Continental, they're just selling off crumbs. It's basically what they're doing. Because here, the reason they do it is, as I understand it, is because for one reason anyway. And again, you're right. I'm not a financial planner and I'm not an oil field expert. But the reason I think they do it is because their leases, so they've got a lease from the landowner, right? And their leases require them to drill within a certain amount of time. Well, they can't drill everything within that period of time. And so they get other drillers in and they just sell it off. Interesting for you guys is that oil and gas wells are actually considered real estate under the tax law. So you can actually do a 1031 exchange on an oil and gas well. It's real estate under the tax law. It's real estate.
Oh, very interesting.
I had a question, maybe just a comment. You're talking about the fraud that is rampant kind of in this industry, and that's one of the reasons we've kind of stayed away from it. It's my understanding oil and gas is one of the most regulated industries in the U.S. Those two thoughts or those two things don't quite coincide, right? help me reconcile that, Tom. What are your thoughts there?
Well, as you know, you're talking about the people raising the capital versus the people doing the actual work. Two different groups, right?
Yeah.
And it's the people raising the capital that are the fraudsters. It's not the people doing the work. The people doing the work, you're right, highly regulated. They've got EPA regulations. They've got all sorts of rules around it. They've got state laws. They've got federal laws. So that's, of course, you also have SEC laws, right? SEC rules. The SEC, why they don't crack down more on the oil and gas fraudsters, I don't know. But it's just easy. It's kind of like easy fraud because you're just saying, well, look, it's kind of like, okay, think of all the ERTC fraud, right? I mean, billions and billions of dollars of, the employee retention credit fraud. Well, why? Because these promoters are out there saying, hey, get free money from the government. That's the same thing that's going on here. Get free money from the government. Give us your 10,000, 20,000, 100,000, million, whatever you're going to invest. And the government will immediately give you a 40% tax benefit, right? So you're only investing 60% of the proceeds if you're in a 40% tax bracket. And that's a pretty sweet deal when you're only taxed on 85% of it. So it's kind of, tax benefits are a double-edged sword, right? I mean, they're good because they get people to invest the way the government wants you to invest, but they're bad in that they do bring out the fraudsters and they're, some of these people that say, oh, this is so good. And, you can get this huge write-up. And then there are people who don't even understand that $100,000 write-off doesn't mean you get $100,000 back from the government. Right? I mean, there's a lot of people don't understand the difference between a credit and a deduction. And a credit, of course, is dollar for dollar, but a deduction depends on your tax bracket. So if you're in a 20% tax bracket and you invest $100,000, the most you're going to get is $20,000. I mean, that's the way math works when it comes to tax deductions. So you really do have to run the numbers. You have to be super careful. And I would not suggest oil and gas as an investment for anybody that's not willing to do really strong due diligence, understand the industry, meet with people who understand the industry and can afford to lose the money, because the chances are you're going to lose the money. Wow.
Without saying specifics, what has been your experience? Has it been overall good? Has it been overall bad? What does it look like?
It's so I've had good and bad investments in oil and gas. I fortunately am not invested with any fraudsters. I know the industry well enough not to do that. Yeah. But I will tell you that one investment, the engineering was absolutely, there was a ton of oil there. The driller could not get through the bedrock. So we all lost our money. All the investors lost their money. The driller wasn't a fraud. It's just that the engineering wasn't as good as it could have been to say, hey, guess what? We can get through this. They tried and they couldn't get through the bedrock. So the oil's still there. As far as I can tell, the oil's still down there. But what do you do if you can't get through, if you can't get to it? So, and then there are others that, like I said, there are some that do secondary and tertiary recovery. There's some public companies that do it, and they've gone through all the SEC regulations, as you know, and they're a little safer, right? They're gonna be really careful. The ones that are public, they're public offerings, not private offerings. You don't have to be an accredited investor to invest, and you invest as little as $10,000. That's going to be a lower risk investment than a private offering, especially if you don't know the driller very well, and you don't know, they can show you, the problem is they can show you all their past results, but as we know, past results are no guarantee of, future results. That's what financial planners always say, right? So, and the same's true with real estate, as we know. People have lost a ton of money in real estate the last couple of years. So there are no guarantees, but you really need to understand the industry.
Tom, this seems like a good win for the investors. Like some great tax benefits. Why does the government or Congress allow these great benefits?
I think from a national security interest, having enough oil is second only to having enough food. You think about the investments that the government incentivizes the most. They incentivize food the most, food production the most, energy production second, and housing third. I mean, right? Businesses fourth, right? But those are the top three that they incentivize. And why do they incentivize them? Well, because they want to encourage more drilling. They want to encourage. We've long had this policy in the U.S. to let's become energy independent, and that's why it is. What's interesting is President Obama and President Biden both in their budgets wanted to withdraw these tax benefits, and they could not get it through even a Democratic Congress. So there's just a lot of incentives, a lot of reasons, I think, public policy reasons to encourage investment in energy, period, whether it's clean energy or fossil fuel energy.
Well, Tom, that's when one of your books, The Win-Win, 7 investments the government will pay you to make. You go into some more detail on that. So that, I think, is a good book. There's also a chapter in there about using insurance, and he goes through an example of using a policy loan to invest. So Tom's got some great books, but just love his wealth of knowledge.
Yeah. Tom, I'm looking back and taking notes while we're talking. One of the things I wrote down was proceed with caution. Right?
Yes.
So oil and gas.
Fair. Write that down 3 times, not just once.
Yeah, right. Well, great tax benefits, but again, as men, I still don't know my comfort level with oil and gas is anywhere for me personally to invest in.
I hope it's not. I hope it's not any. Seriously, I'm comfortable, but I've been involved in the industry for 45 years. So, and I saw people I've seen people do it the right way, right? I've got clients that have made money at it. I've got clients that have lost money at it, just like any other investment. And just more than I think about any other investment, it's the team that you're investing in more than the product.
Great point. Yeah.
Yeah. The team is so important, and it's, the engineering team, the accounting team, frankly, the leasing team. I mean, all of these people, the first thing is, are they honest? And in oil and gas, I mean, you're maybe 50-50 on that one. Right. And then second of all, are they competent? Okay. Well, now you're down to 25%. Right. So it's, and what the other thing I found is be very careful about real estate developers who promote oil and gas, because they don't know oil and gas. They know real estate. But I've seen this year, I've seen in 2023, 2024, a lot of real estate people, because they have not found real estate deals. Oh, well, we're going to raise money for oil and gas. I'm going, wait a minute. It's like, but then I saw a number of years ago, I saw oil and gas people when oil prices were at 30. I saw oil and gas people raising money for real estate. I'm going, I don't like that anymore.
Yeah.
Interesting. Tom, you had mentioned early on that one of the catches to get this benefit is that you need to be a general partner. Yep. So you can't have some of that asset protection you may normally have in an LLC. What is the risk for an investor to be a general partner on something like this?
Yeah. So that's where you've got to, this again goes back to your team, because you've got to make sure that the driller, the developer, has a lot of insurance. Okay. Because you're dependent on the insurance coverage. Because otherwise you have unlimited liability. The other thing you want to look at is how much leverage do they have? Because leverage is something we talk about all the time in real estate, but not something you hear a lot in oil and gas. And the reason is because, wow, that leverage could really hurt you if there was some disaster at the oil, at the drilling site. I mean, like if you were invested in some offshore drilling rig, which you probably aren't going to be in a private equity. situation. But if you were to invest something like that and the whole thing blew up, right, or you had this big oil spill or something like that, I mean, there's environmental issues, there's safety issues, there's all those things. So you need to make sure that there's enough insurance so that you're covered from a liability standpoint.
Great. Tom, what a ton of information as usual. Really appreciate you coming on. But before we wrap this up man, you've got a Wealth Ability podcast as well. How often are episodes going out?
Yeah, so we send out an episode every week, the Wealth Ability Show, and it's both YouTube and podcast.
Great. We'll put a link in there. And then one thing that we talked about prior to us recording was that you also have Wealth Ability Live. Tell us a little bit about that. I think that's a great spot for our listeners to tap into.
It is. If you want a little more deep dive into topics, we bring in guests from time to time to go into a topic. For example, we had a really good guest on the Corporate Transparency Act on Wealth Ability Live, and then you can ask questions to the expert. About half the time, it's just me. And most of it is question and answer. So it's just it's a way for me to actually understand what's on the mind of the average entrepreneur from a tax standpoint, or investor from a tax standpoint. And I get to teach. And so it's a really good exchange. We try to make it so inexpensive that anybody can afford it. That doesn't keep anybody out. Our one-on-one professional services are a little pricier than that, so it keeps some people out. But this one we want to make low enough that nobody's kept out because of price.
And you mentioned, and how much is that price?
It's $97 a month, and we do 2 webinars a month, and we record them.
And we have the ability to ask the expert and or you a question.
Yep.
Now, just to get some perspective, I know you have some of your CPA advisors. What is their, if we were to like hourly rate, 3 plus an hour?
400 plus an hour.
Yeah.
Yeah. And my fees are considerably higher than
more. Yeah. But I just want to make what a great value of paying to be able to get access to those questions and to those experts. So great value there, Tom, and great value of being on our podcast. And I appreciate you not rubbing into Cameron that he's not a CPA. He's just a normal civilian.
Actually, I'm jealous a little bit.
Well, Tom, I would tell you, he was so excited about this podcast. Normally he does like deep hair conditioning every 2 weeks, but he's like, hey, Anthony, Tom's coming on. I got to move around. I'm getting deep conditioning this weekend. So you can tell his hair's on point for you on this Monday.
Thanks, man. Thanks.
So thank you, Tom.
I do have a little hair envy there. So
yeah, I do too, which is why I make fun of it.
All the time. Every episode. He never misses. He never misses.
Hey, I would do the same.
Yeah, see?
Tom, thanks again. This has been very enlightful. And man, I appreciate the information you're sharing with our listeners. Thanks again.
Yeah, anytime. Thanks very much.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.